know why your company's balance sheet is so important? I do, and I'll share some quick tips on how to read them and understand some of the basics of this important financial statement.
Welcome to this episode of Accounting and Tax Tips, Smart Strategies for Small Business Success, with certified public accountant Tina Moe.
The balance sheet, also known as the statement of financial position, is a snapshot of a company's finances as of a specific date. For instance, if you were to apply for a loan, the bank would ask you to fill out an application to help determine if you are a good lending candidate. This application would ask you to list your assets and debts and would give the bank the amount of your equity. The basic formula for a balance sheet follows this principle: assets plus liabilities equal equity. The first section of the balance sheet starts with the assets of your business and lists them in order of liquidity. I'll come back and explain the concept of liquidity in just a moment. The asset section would include your checking account, savings account, your accounts receivable, inventory, and other assets such as equipment, business vehicles, and real property, which refers to buildings. The concept of liquidity refers to how quickly an asset can convert to cash, so that's why the checking and savings are listed first, then accounts receivable, or money that people owe you, and then inventory. All of these are either cash or can be converted to cash quicker than equipment and real property, so that determines how high up in the list of assets they appear on the balance sheet. The next section of the balance sheet is the liability section, or the debts of the business. And this is split between current liabilities, long-term liabilities, and current liabilities are listed first, which means the debt will be paid within 12 months, and long-term liabilities means that they'll be paid off in more than 12 months. An example listing of your liabilities would begin with accounts payables, things like your phone bill, your rent, insurance bill, or other regular recurring bills that you pay in your business. Next would be debts such as credit card balances or payroll taxes that may be due the next quarter. And the last section would be any long-term liabilities such as mortgages, equipment loans, or vehicle loans exceeding a 12-month payback period. The final section of the balance sheet is the equity section, and this is essentially the book value of the business. Typical accounts found in the equity section of the balance sheet are common stock, additional paid-in capital, and distributions, as well as the current year's net income from the profit and loss, which adds to the equity of the business, and conversely, a net operating loss will reduce the equity on the balance sheet. I hope this sheds a little light on the mystery of the balance sheet. It really is just a snapshot of what your business owns and what it owes and the difference between the two. For more information on this and other fascinating accounting and tax topics, be sure to check out my other shows here on IndieBiz TV or visit my website at www.actservices-inc.com.
Thank you for watching this episode of Accounting and Tax Tips with Tina Moe. For more great information, visit Tina's website at www.actservices-inc.com. Also browse the other shows found right here at IndieBiz TV Shows.